Since Ben Bernanke introduced us to the concept of tapering nearly a year ago, the Fed has pulled back its monthly bond purchases by $20 billion, throwing some markets around the world into what has been called a taper tantrum. I recently spoke to David Kaufman, president of Westcourt Capital, and started by asking him to explain the delicate act of cutting back on stimulus.
Before you have tapering, you have to have quantitative easing, or QE, happening, which is what's happening in the U.S. They had a bond buying program over the last number of years where they were buying $85 billion of bonds a month, and they went down to 75, and eventually they're going to try and get down to a lower number. Why do they do this? They do this essentially to pump liquidity into the system, which is a fancy way of saying they're trying to keep the economy afloat, like training wheels. The problem is that what happens is that the economy depends on this like a drug. Think of it like heroin, that they depend on all of this new liquidity coming into the system to keep coming along. And everyone knows, like heroin, that it's bad to do it a little, it's really bad to do it a lot. So you have to figure out how to taper the intake.
So I feel like I should say it's bad to do it all.
It's bad to do it all.
Yeah, okay.
Yes, I did say it's bad to do a little.
Okay.
Here we go.
Yeah.
So you need to figure out a way to taper it down, sort of the equivalent of the methadone clinics. Like, you can't just cut the patient right off because they're going to crazy withdrawal. Like, the markets do not like the idea of uncertainty.
Yes.
So the question is, how do they bring it down, and what metrics do they use to know when? How do you know when? It's a big place, the U.S.
So one of the things that's been interesting is all of the stimulus, and that was first monetary policy stimulus, and now this like literal bond buying, which we should note is buying of the bonds from the same people who are issuing the bonds. So it's a kind of a crazy situation, but it's, as you say, a way to print money. They have decided to stop doing that. That should be a healthy signal. That should say to the market and everybody at large, they must feel better about the economy. They don't need to do this, right? It's the equivalent of the fire is out, we're taking the fire trucks away. Why do people freak out at the idea of taking the fire trucks away?
Because we don't know that the fire's out. Think of it like training wheels. You know, there's training wheels on the bike. You're pretty sure the kid knows how to ride without the training wheels, but the only way you're going to find out is by actually taking them off. And if those training wheels, you know, is your retirement account, then the market doesn't know for sure what's going to happen. So there's only two options. Either the economy really is getting better, which is a terrific thing in the long run, but when you take all of the liquidity out, there's a new type of uncertainty, which is how healthy is it? Or even worse, you get false signals and the economy is not really better, and you take away this liquidity in the system, and what you're left with is a really sick patient. You know, I've been mixing a lot of metaphors here, but the point is you're not exactly sure where you're going to end up. And as you take your foot off that pedal and you ease off with this pumping of liquidity, the reason the markets get jittery is they generally don't like uncertainty. And there's nothing more uncertain than what happens when you stop doing something that's never even happened before in the first place.
Right. It is a bit of an experiment, and metaphors are fine as long as the kid on the training wheels isn't doing the heroin. I'm good with that. I want to talk about what individuals should think about this, because so far this has been kind of on the level of, you know, monetary policy theory, macroeconomic stuff. If you're an individual investor, you see what it means when you see stock markets plummet at the threat of tapering. Do you taper-proof your portfolio? Should you be paying attention in that way?
Probably not. Your goal as an investor should be what the Fed's goal is, which is the long-term health of the economy. Because when an economy is healthy, stock markets naturally rise along with inflation. So what you should be thinking is, if I have any equity exposure, and if you're an investor in Canada, you probably have equity exposure either to Canada or the U.S. And if it's in Canada, of course, the Canadian stock market is tied in many ways to the U.S. stock market and the global markets. What you hope for is that the key metric that the Fed has decided to use as, you know, an indicator of whether the economy is healthy is the unemployment rate in the U.S. What you hope is that they're right. Because if unemployment really is going down in the U.S. month after month, slow but sure, you know, Obama says it's too late, but it's better than never, and it could be better, but it's a lot better than it was, then you should actually be able to withstand these little blips that happen where the day traders aren't sure what's happening tomorrow. But if we can all be pretty sure that the economy is slowly but surely actually repairing itself and nursing itself to long-term health, that should make you as an equity investor happy. And so that when there's tapering, that should be a good thing.
It should be. We're also obviously watching, especially in that U.S. market, the fundamentals of stocks and wondering whether they've gotten ahead of themselves. Could you get caught in a kind of a double bind here where bonds aren't the place to be because tapering is happening and stocks are about to sell off because the fundamentals don't support what they've already done?
Yeah, no, of course, if stocks end up selling off, then bonds are the place to be, because every time we say that interest rates can't go down any further, they do. And so it really is a question that either you have a crystal ball which I'm not fortunate to have. Or what you need to do is have a well-balanced portfolio in the first place. So stocks and bonds, yes, those are two obvious asset classes. Holding a little bit of cash is not bad, because if there is a pullback in the equity markets, you'll have some dry powder to pump back in yourself. That's putting your own liquidity into play. And you should, of course, consider alternative investing, which is a whole other area which we spend a lot of time looking at, but it's very difficult for a lot of retail investors to access.
All right. Unfortunately, we got to leave it there. Thanks, David.
Pleasure.